Welcome to The Explainer. Today, we're going to decode the massive changes to the EPFO's Electronic Challan cum return system, or ECR. If you're someone who deals with payroll or company compliance, trust me, this is a really big deal. So let's jump right in and find out what this huge overhaul really means for employers all across India. To really get why the new system is the way it is, we have to remember how painful the old one was. For years, it was just a massive headache, right? Endless corrections, chasing people up, getting notices from the department. It was a mess. So what was the biggest problem? Well, it was this simple thing. Filing your data and paying the money happened all at once. It was one single action. Now, imagine you make one tiny mistake, just one wrong number in a salary. And because you've already paid, it's locked in. Done. Fixing it? Oh man, it was a nightmare of paperwork and follow-ups. And worse, the employee's PF account would be wrong for months. Alright, so what's the one big idea that fixes all of this? It's actually a complete change in how we think about the process. The whole new system is built on one, honestly, revolutionary idea, separating the filing from the payment. You're not doing it all in one go anymore. This simple split, well, it's a total game changer. So, here's how your new monthly journey looks. First, you upload your data file. Then, the system itself gives it a quick check for basic errors. And here's the most important part. It gives you a chance to download a statement, verify everything, and formally approve it before you even think about paying. It's your safety net. And this is the perfect way to think about it. It's exactly like online shopping. You add everything to your cart, you double check it, you make sure the total is right, and only when you're 100% sure everything is perfect do you hit pay. That's the whole philosophy here. Catch mistakes before the money is gone. Okay, so how do you actually manage this whole file first, pay later thing? Well, the system doesn't just leave you hanging. It gives you a brand new set of specialized tools, each one designed for a different situation you might face. See, instead of that old, clumsy, one-size-fits-all method, you now have 3 very specific types of returns, and knowing which tool to use for which job, that's the secret to getting it right every single time. Now, this is super interesting. It lays out your entire toolkit for you. The regular return, that's your main filing every month, the one you have to do. What if someone joins late and you've already filed? No problem. You use a supplementary return just to add that person. And for mistakes, that's the revised return. But, and this is a big but, notice the rules here. It's easy to add more money to increase what you owe. But if you want to pay less, you have to catch that mistake before you've initiated the payment. All right, so with all these new tools, you've got to understand there are new rules. And honestly, some new risks you really need to be aware of. This system is smart, but believe me, it is not very forgiving. So where's the biggest risk hiding now? It's not really the system itself anymore. The biggest danger is now our own internal processes. A simple human error that can now cause some pretty major problems down the road. And to handle this risk, you absolutely have to start using what's called a maker-checker system. It's a standard thing in finance, really. Super simple. One person prepares the file, that's the maker, and a completely different person checks it, the checker. This one simple step can catch almost all of those common, silly mistakes. And this is maybe the most important thing to remember. That approve button, it's not just another click. Think of it as signing a legal document. It is final, it's irreversible. Once you click that button, your liability is locked in. There is no undo button. This whole focus on getting the data right brings us to probably the single most critical task for every single HR department under this new system. Okay, so what happens if an employee leaves and you forget to mark their exit date on the portal? Well, they become a ghost employee in the EPFO's records. And here's why that's a disaster. The new system is chronological. You can't file for February until January is completely done. So that one ghost employee from January can block your entire company's PF filing for February and for March. Basically forever, until you fix it. It's a domino effect that can bring everything to a grinding halt. Okay, so how do you avoid all these scary problems? How do you get your business ready for this new world? Well, the plan is actually pretty straightforward. It's all about being proactive. Here are 3 simple, actionable things your company needs to do right now. 1. Clean up your data. Go into the portal and mark every single person who has ever left. Get it done. 2. Make that maker-checker process official. Don't just talk about it, actually assign the roles. And 3. Archive everything. I mean, everything. For every month, keep a digital folder with the text file you uploaded, the statement you approved, and the payment challan. It's your perfect audit trail. Look, at the end of the day, the old way of doing things, that whole file now, fix it later habit, is over. It's gone. The system just won't let you do it anymore. This leaves one big question for you and your business to really think about. Thanks so much for joining us for this explainer.
If you're involved in payroll, finance, or HR compliance in India, you definitely know the feeling, that sinking feeling when you spot a mistake in your PF-ECR filing.
Oh, yes.
And the payment is already done out. It's probably the biggest headache, right?
Absolutely. That moment is just filled with dread. The old system, it was really the definition of reactive compliance. Mistakes got baked in, and corrections, well, they were messy, unclear, took ages. It wasn't just admin hassle either. It genuinely caused problems for employees down the line.
Right.
Trying to get funds back from the EPFO, that could take months.
Exactly. Well, that whole cumbersome, sort of stuck-in-the-mud approach, it's finally getting a major overhaul. Okay, let's unpack this.
Good.
Our deep dive today is all about getting you up to speed quickly on the EPFO's re-engineered ECR system. It officially kicks in from September 2025. And look, this is way more than just a new website. It's a whole new philosophy.
It really is. What's fascinating, is how the basic idea has flipped completely. We're moving away from fixing mistakes after you've paid. Now, it's all about mandatory validation before you submit anything. This revamped ECR, it's designed to basically force discipline, transparency, and accuracy right at the source. With you, the employer.
Before any money moves.
Precisely. You have to get the data right first. That's the non-negotiable steps to even generate the payment challan now.
Okay, so let's dig into that foundational shift first. Our sources are calling it the cornerstone of the whole thing.
Yeah.
Separating the data return filing from actually generating the payment.
That's the core chip.
Before, those two were basically bundled together, weren't they? You uploaded the data, the challan topped up, and bam, you were committed. Errors and all.
Locked in, effectively. The new system carefully pulls that apart. It introduces this very deliberate 5-stage process. You can't skip steps.
Okay.
First, you upload the data. Then the system has to validate it. Then you approve the return statement. Only then can you generate the challan. And finally, you pay.
I quite like the analogy one source used. It's like online shopping. You put your items, that's your employee data, wages, contributions into the cart. That's the upload. But before you even get to the checkout, the system automatically checks everything in your cart. That's the validation stage.
And that validation, it's crucial. It's where the system does a sanity check. Does this employee actually exist in the records? Is their UAN, their universal account number, correct? Does the joining date make sense for these contributions?
Though it catches basic errors up front.
Exactly. It's the first line of defense against those common clerical mistakes that caused so much trouble before.
Okay, data validated. Then you review the final summary, the system-generated return statement. And here goes the big moment, that approve button. Why is clicking approve so much more significant now? It's not just ticking a box, is it?
Not at all. Clicking approve is now, legally speaking, a binding declaration.
Okay.
You, the employer, are certifying to the EPFO that all the data you've presented, wages, contributions, UANs, everything is accurate and complete. That single click establishes your legal liability for that month's compliance. And importantly, it happens before you've even initiated the bank transfer.
Which means internal processes inside companies have to change immediately, right? The sources really stress this need for a maker-checker system.
Absolutely mandatory now.
So the maker, maybe the payroll team, prepares and uploads the data. But the checker, someone senior, perhaps from finance, maybe a manager has to independently verify that return statement.
Yes.
Before hitting that final approve.
Exactly. And that checker's role, it's not something you can just delegate down anymore. It needs proper sign-off. They need to be looking at the total liability, doesn't match the books. Are there any unexpected new people included? Are all the people who've left correctly shown with zero liability? This separation of duties isn't just good practice. It's a core financial control now. Helps protect against mistakes, even potentially fraud.
Okay, so we have this tight 5-step workflow, but, a real-world payroll gets complicated. People join mid-month. Mistakes sometimes get found right at the last minute. How does the new system handle that kind of necessary complexity?
That's where the system gives you specific tools. 3 different types of returns, replacing the old, rigid way. First, you have the regular return.
Right.
That's your main monthly filing. The primary one for declaring and paying contributions for all your active employees. It must be filed first for any given wage month.
Okay, makes sense. Then there's the supplementary return. This sounds like the system acknowledging that sometimes things don't fit neatly into the main payroll run.
Precisely. The supplementary return is used only for one thing: adding new joiners or members you missed after you've already approved the regular return for that same month.
Okay.
So if someone's paperwork comes in late, after the main payroll is done and approved, you use this. And you can file multiple supplementary returns for the same month if needed. It gives you flexibility without holding up your main compliance.
Got it. And finally, the revised return. This is the designated tool for fixing mistakes in data you've already filed.
Yes. Specifically for correcting wage or contribution data for members you've already submitted in a regular or supplementary return. And this is where you see a really important difference in the main financial risk. It depends on what you're correcting.
So,
let's look at upward revisions first. Say you need to increase someone's wages or contributions because you underreported initially.
okay.
The system is quite flexible here. You can file this revised return anytime, even if you already paid the lower amount. And the system automatically calculates the interest due for the delay.
The interest. That's Section 7Q, right? Let's just quickly clarify that for everyone. What's the rate?
Yes. Section 7Q interest is for delayed payments. It's calculated at 12% per annum, simple interest. Before, this often came as a separate notice later on.
Right.
Now it's integrated. If you underpaid PF in, say, September, and you fix it with an upward revision in November, the system calculates those 2 months of 12% interest on the difference right there and then. You pay it along with the corrected amount.
Okay, that's clear. Immediate liability. Makes you want to get it right the first time or fix it fast.
Exactly. But now, the other side. The downward revision. Trying to decrease wages or contributions you've already filed. This is where the system puts up a major barrier.
The trap.
Precisely. The EPFO's priority here is protecting the employee's funds. So once you have initiated the payment process for a return, meaning you've hit approve and generated the Challan or the TRN, downward revisions for those members are strictly blocked. System won't allow it. This creates what we're calling the overpayment trap.
So if payroll messes up, overstates contributions, finance approves it, pays it, that extra money is just stuck.
Essentially, yes. It's with the EPFO. To get it back, the organization has to go through a separate, often complex and lengthy offline process to claim a refund.
That sounds like a serious cash flow risk. Forget the admin burden.
It absolutely is. This block really forces organizations to be first time right, not just for compliance sake, but for managing their own money. The EPFO is basically saying, double check, triple check before you approve and pay. Because once those funds are committed, reclaiming them is the exception, not the rule. And this leads us to where the new ECR really shows its teeth as a compliance enforcer. It uses strict, built-in rules that hinge entirely on how clean and up-to-date your employee master data is.
Okay, sounds serious. What's the first one?
It's the chronological filing mandate. This is a big one, especially if you manage compliance for multiple locations or divisions.
How does it work?
It's a system lock designed to prevent backlogs. Simple rule.
Yeah.
You cannot file a return for the current month, let's say October 2026.
Right.
If the return for the previous month, September 2026, hasn't been successfully filed and approved. Full stop.
Wow. So one single problem in 1 month
Creates a cascading failure. It halts all future PF filings for your entire organization. Penalties start accumulating across the board. It forces you to resolve issues immediately.
That demands incredible discipline. And you mentioned master data. What's the link?
The easiest way to fall foul of this and other rules comes down to one seemingly simple admin task: marking exits.
For employees who've left.
Yes. When someone leaves, their date of exit must be marked accurately and, crucially, immediately on the EPFO portal. This has suddenly become probably the most critical routine HR task.
Why immediately? What happens if it's delayed?
Because if you don't mark that exit, as far as the EPFO system is concerned, that person is still an active employee. They become a kind of ghost employee in the records.
Nope.
And that ghost employee is basically a ticking time bomb connected to the most powerful enforcement rule of all, the month 4 prior rule.
Right, the compliance cliff. Tell us about this one. This sounds like the one everyone really needs to understand.
It is. This rule kicks in after the initial transition period ends, so after December 2025. Once it's active, the system performs a strict look-back check every time you try to file.
A look back.
Yes. You can only file your regular return for the current month if the returns for all members who were active 4 months prior have been fully accounted for and paid.
Okay, let me process that. So if I'm filing for May, the system looks back to January.
Exactly. And it checks everyone who was marked active in January. Now imagine you had an employee who left last December, but HR forgot to mark their exit.
So they're still showing as active in January in the system, a ghost.
Precisely. So when you try to file for May, the system looks back 4 months to January and says, hang on, this person was active in January according to our records, but you haven't paid their contributions for January, February, March, or April, and they're still marked active now.
Even though they actually left ages ago?
Doesn't matter to the system. It sees an active employee with missing contributions from 4 months prior. And because you can't submit a return that includes a contribution for someone who isn't actually working for you,
Your entire May filing for everyone gets blocked.
blocked completely. That one piece of old, neglected data, the unmarked exit, suddenly brings your current business operations, your compliance, to a dead stop.
That's huge. So that relaxation window, September to December 2025.
It was absolutely not a holiday. It was a critical one-time window provided by EPFO for employers to conduct a mandatory data cleansing project. Go back, find all those historical unmarked exits, and get them updated on the portal.
To avoid falling off this cliff after December.
Exactly. Failed to do that cleanup, and you're basically setting yourself up for a major operational blockage down the line.
Okay, let's move to the final piece. Penalties and financial controls. The system isn't just validating data. It's also calculating and enforcing penalties much more directly now.
Absolutely. We touched on Section 7Q interest earlier, that 12% per annum simple interest for paying contributions late.
Right.
The key takeaway now is that this calculation is automatic, it's integrated into the system, and paying it is mandatory along with your monthly contribution if there's a delay or an upward revision.
So the financial hit for being late is immediate and transparent. No more waiting for a separate notice months later.
Exactly. It's right there on your Challan. It has to be budgeted for as a potential cash outflow if processes aren't tight.
Now, on the payment side, the due deposit balance summary page offers more than just full payment. You mentioned part payment. Why would a company use that? It sounds complicated.
It's actually a very useful tool for risk management in certain situations. To do a part payment, you have to upload an additional contribution file.
Okay.
This file specifies exactly which employees or which liabilities you are paying for in that transaction. Now, imagine you have a dispute maybe about the correct wage calculation for a group of highly paid employees.
Right, a genuine disagreement on the liability.
Instead of holding back the entire PF payment for everyone and racking up 7Q interest on the whole amount, you can use part payment. You pay for the, say, hundreds of employees whose contributions are not in dispute.
Ah, I see. So you isolate the disputed amount.
Precisely. You stop the interest clock ticking for the vast majority of your workforce, protecting your cash flow while you resolve the specific issue. It's about containing the financial damage.
That makes a lot of sense. What about other charges?
You can also generate separate direct challenge just for statutory charges like admin or inspection charges, or even for those more serious Section 14B damages if they get levied. Keeps the accounting clean.
And linking all this data and payment together is the TRRN.
Yes, the TRRN, the temporary return reference number. This is absolutely vital.
Well, critical.
Because it's the unique code, the digital thread that connects the specific data you approved, the return file ID, to the specific payment challenge you generated and paid. For any future audit, internal or external, the TRRN provides that concrete, undeniable link. Proof that the money sent corresponds exactly to the data you certified. It's your audit trail.
Got it. So pulling it all together, this new system really forces that internal collaboration, doesn't it? HR owns the exits, payroll owns the accurate data prep as the maker, and finance absolutely has to own that final approve click as the checker.
It mandates it. You need clear standard operating procedures, SOPs, that reflect this. Validate first, then approve, then pay sequence across all those functions.
So wrapping this up, what's the bottom line for everyone listening right now? What does this all mean practically?
The core message, I think, is really clear. This new ECR system fundamentally shifts compliance. You're moving away from reactive firefighting.
Trying to fix things after the fact.
To proactive prevention. It demands you get things right the first time. And the benefit, well, it's designed to cut down on all that ambiguity and hassle that led to employee grievances, those long waits for refunds. It forces accuracy right at the start.
Before the problems even begin.
Exactly. Think of it like the EPFO has given you this very structured gatekeeper for your compliance. And this gatekeeper, it's smart. It refuses to let you proceed with your current filing if your historical data, especially about people who've left, isn't clean.
So you, the employer, you basically have a strategic choice to make right now.
You do. Choice one. Use this period. Use the tools, do the hard work now, undertake that data audit, clean up potentially years of messy or incomplete exit data, get your house in order so you can navigate this new system smoothly. Or choice two.
Yeah.
You ignore it, you put off that historical data cleanup, and you run straight into the month 4 prior rule sometime after December 2025.
And that neglected data suddenly becomes a brick wall.
A critical operational blocker. It stops your current filings dead. It impacts business continuity. So the real question isn't if poor historical data will cause a problem under the new system. It's really just a matter of when.
So the final thought for you listening is, which path are you on? The proactive cleanup or waiting for the compliance cliff?
The smart move really is to start that data audit project today. Don't wait.